Welcome to this explainer. Today, we're unpacking a strict value investing critique of the highly hyped business models behind Elon Musk's most famous ventures. Yeah, we're talking about Tesla and Spacex. We're going to dive right into Dr. Sven Carlin's financial analysis. He basically looks past the roaring headlines and zooms right in on the balance sheets. So, if you've been watching all those incredible rocket launches and soaring stock prices, kind of wondering how the underlying math actually works, well, you are in the exact right place. We're going to separate the grand, futuristic myths from the cold, hard, mathematical reality. We're kicking things off with this striking quote from billionaire investor Bill Ackman. It really sets the grounded, math-driven lens we'll be using today. Value doesn't go into the same tweet with SpaceX. Okay, so what does he actually mean here? Well, he's saying that traditional metrics of value investing, things like cash flow, profit margins, retained earnings, they are fundamentally disconnected from how the market currently prices these futuristic tech giants. Ackman's perspective perfectly sets the stage for our central thesis today, the idea that we might just be looking at a massive pricing distortion. Here is our roadmap for today. First, the space mega bubble. Second, the Tesla financial precedent. Third, pushing new promises. Fourth, SpaceX's interplanetary economics. And finally, the capital furnace model. All right, section 1, the space mega bubble. Right now, Wall Street is absolutely thrilled. These related stocks are up 50%, investment banks are raking in massive fees, and they're already lining up the next wave of IPOs to, you guessed it, generate even more fees. But we really have to ask, are we witnessing sound investing here, or is this just a cult of gambling? Think about it. When a stock goes up purely because other people are buying it, completely ignoring the business fundamentals, well, that is the textbook definition of a bubble.
Moving right along section 2, the Tesla financial precedent.
To really grasp the projected trajectory and those trillion-dollar valuations of SpaceX, we can't just look at it in a vacuum. We've got to use Tesla's 15-year history as our financial precedent. Just look at the reality of these numbers. Over 15 years, Tesla raised $44 billion from investors, but the retained earnings, just $39.5 billion. So despite literally revolutionizing the global auto industry and becoming a massive household name, the math reveals a $6 billion lifetime loss. To put that into perspective, the return on that massive $44 billion investment is incredibly weak for a company of this maturity. There are no buybacks, no dividends. It's a real eye-opener. And on top of that, the financial pressure is really mounting. We're seeing a clear deceleration in vehicle revenues. Why? Well, naturally, competitors have figured out how to build electric vehicles too, which is seriously compressing those profit margins. Yet, even with slowing revenues, their capital expenditures are climbing to a staggering $10 billion annually. Think about that. This mature company is still burning through a massive amount of cash every single year just to stay ahead of the pack.
Which brings us to section 3, pushing new promises.
So put yourself in their shoes. If you're a company facing decelerating profits in your core business, how do you maintain that sky-high premium valuation? Well, when the EV story kind of loses its shine, you pivot. Suddenly we're talking about AI training clusters, then, it's Optimus robot factories. And now it's cyber cabs. The analysis points out this is a deliberate strategy. You distract the market from those compressing margins today by selling an unproven sci-fi promise of tomorrow. The story is always about what's going to happen 5 or 10 years from now, rather than the actual cash flow being generated today. Let's jump to section 4, SpaceX's interplanetary economics. This exact same narrative-driven blueprint builds right into the ultimate expression of this business model, and that's SpaceX. Look, making life multiplanetary is a genuinely inspiring mission, for sure. But let's step back and look at the math. Mars has disastrous temperatures and zero breathable atmosphere. It's profoundly ironic, isn't it? We struggle to build affordable housing right here on Earth. So how exactly is anyone turning a profit building condos on a barren, hostile planet? The whole idea of Earth-like entertainment centers on Mars might look super cool in a pitch deck, but the actual realistic profitability of an endeavor like that, it is wildly unproven. Okay, but what about the space internet engine, Starlink? The current revenue generator. Well, even if it hits 10 million customers, that's maybe $10 billion in revenue. Now compare that to a grounded giant like Comcast, sitting at 47 million customers and $120 billion in revenue. It's a huge difference. Yet, SpaceX's valuation rivals or even exceeds the most mature, profitable companies on Earth. As the explainer points out, the fundamentals simply do not align with the hype. So you might be wondering, how are these astronomical valuations justified in those pitch decks? usually through a metric called EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. In a heavily capital-intensive space company, relying on EBITDA conveniently hides the massive real-world costs of depreciating rockets and satellites. By capitalizing these massive expenses instead of just expensing them immediately, a company can make its finances appear incredibly profitable on paper. In fact, the legendary value investor Charlie Munger famously dismissed EBITDA with just two blunt words: bullshit earnings. And that really hits the nail on the head here. When a business leans heavily on EBITDA to show success, it actively masks the reality of its financial health. It obscures the plain fact that they are spending significantly more cash to build out their infrastructure than they actually bring in from their customers. And the resulting math from all this hype is literally staggering. Based on recent private funding rounds, Spacex is effectively trading at 120 times its $18 billion in revenue. 120 times. That gives it a $2.5 trillion implied market cap, completely eclipsing proven global profit engines like Amazon. The takeaway here is that even with a massive moat, dominating an industry doesn't automatically make it a sound financial investment. Not if the price you pay is 120 times revenue for a business that is burning massive amounts of capital. This brings us to our final section, Section 5, the capital furnace model. Here is the core mechanism at play. The capital furnace. Think of it like a giant machine that simply doesn't generate self-sustaining cash flow. Instead, you shovel investor money into it, and what comes out the other side isn't profit, it's a grand new promise about the future. That promise generates fresh hype, which inflates the valuation, which then allows the company to raise even more capital to keep that furnace burning bright. Which leaves us with one final provocative question. If this entire multi-trillion-dollar model relies on venture capitalists and everyday retail investors continually paying a premium for the next futuristic promise, what happens when the capital furnace finally runs out of fuel? Who ultimately is going to be left holding the bag? It's an absolutely crucial question to ask the next time you see a rocket launch driving a massive stock surge. Thank you so much for joining me on this explainer. I really hope this provided a clear, structured lens for you to view these massive market valuations. Keep questioning the math and keep learning.